Hi, welcome back to Accounting 161. My name is Stan, and we're going to look at Unit 2, and this will be part 1 of my lesson. Before we go any further, I just want to introduce what is the accounting cycle. These are standardized steps to complete the accounting records for each period. Normally, organizations complete their accounting on a monthly basis, and so we will do this on a monthly basis. And you can see the 9 steps to the right here. And we've largely taken a look at step 1 already in terms of analyzing business transactions and how it affects the accounting equation. Then we're going to create a general journal. We're going to post those journal entries to a ledger account, and then we're going to prepare a trial balance. Then we're going to make some adjustments and then prepare financial statements. We're going to go through each and every one of these steps slowly. And so this is what we're going to do going forward. We've already taken a look at one approach to analyzing financial transactions, and now we're going to apply an accounting approach to doing the same thing. So I'm going to start explaining what journal entries are, what journals are, and we're going to take all of the material that we've learned in lesson unit 1, and we're going to apply it to making journal entries for our accounting system. Okay, let's get started with the accounting cycle. The first step is analyzing business transactions. In the introduction, we already took a look at the impact on the accounting equation for 10 transactions of SoftBite SA. In this section here, we're going to take a look at how we can turn those impacts into accounting entries. Specifically accounting journal entries. Before I can do that though, I need to introduce the concept of debits and credits, and then we can begin making journal entries. Earlier in the introduction, we talked about the chart of accounts, and I'm just going to go back to that for 1 second as a reminder here. So an account is an individual accounting record of increases and decreases in a specific account, whether it's cash or whether it's accounts payable or equity. In accounting terminology, we're going to consider the left side of the account as the debit side and the right side of the account as the credit side. So instead of talking about the impact on the accounting equation as increases and decreases, we are now going to start talking about it in the context of debits and credits. So let's get into a few specifics here, and let's talk about debits and credits. So what is a debit? It indicates the left side of the account. It's abbreviated as DR, and an account is known to have a debit balance if the total debits is greater than total credits. So that's a debit. On the flip side is a credit. What is a credit? It indicates the right side of the account, abbreviated as CR. An account is known to have a credit balance if the total credits is greater than the total debits. Now I'm going to introduce the concept of a normal balance, which is an account balance on the side where an increase in the account is recorded. So this is how we're going to record an increase. And so now, in double entry accounting, we have to analyze business transactions. Each transaction must be recorded with equal debits and credits, and the sum of all debits to the account must equal the sum of all credits. So that's actually very important. In the next few slides, I'm going to talk about the normal balances for each of the categories in the chart of accounts. As I mentioned, this next section is vital for our understanding of accounting. Let's get right into it. So let's take a look at asset and liability accounts. Let's take a look at assets first on the left side of the diagram. A normal balance for assets is the debit side or the left-hand side. So if we're going to show an increase in an asset, we're going to debit our account. if we're going to show a decrease in an asset, we're going to show a credit in the account. For liabilities, it's the exact opposite. To show an increase in a liability, we're going to credit the account. The normal balance is a credit balance. And to show a decrease in a liability, we're going to enter a debit. So paying attention to normal balances is vital to our understanding of how to make journal entries. Now let's take a look at the equity accounts. So share capital, this is the initial investment by the investor. We're going to show increases in share capital by making a credit. So the normal balance for the equity account is a credit balance. And we're going to show decreases in the balance with a debit. The same applies to retained earnings, because retained earnings are also part of the owner's equity. We're going to show increases in retained earnings by making a credit. So the normal balance for retained earnings is a credit balance. And we're going to show decreases in retained earnings with a debit. Now let's take a look at the dividend account. Remember that dividends or withdrawals are funds that the owners will take out of the corporation. So you can imagine that the normal balance for the dividend account is the opposite of the equity and retained earnings account. So we're going to show increases in the dividend account with a debit entry, and therefore it has a normal balance of a debit balance. And we're going to show decreases in the dividend account with a credit entry. And finally, let's take a look at the revenue and expense accounts. And now we can see here, increases in revenue. The normal balance is a credit balance. And therefore we're going to show increases in revenues with a credit entry, and decreases in revenue as a debit entry. Expenses are going to be the exact opposite. We're going to show increases in expenses as a debit entry. So the normal balance for an expense account is a debit. And we're going to show decreases in expenses as a credit balance. Now, just as a review, and I strongly suggest that you pause the video at this point just to make sure that you understand the normal balance for each of the different types of accounts that we have here. And so now we can see here that for assets and also expenses and dividends, the normal balance is a debit balance. That's how we're going to show increases in assets or expenses and also dividends. For liabilities, share capital, retained earnings, and also revenues, the normal balance is a credit balance. And so that's how we're going to show increases in those accounts, is by making a credit entry. And as I said, I suggest that you pause the video at this point to review the normal balance for each of the different types of accounts. Now let's move forward to step 2, journalizing the transactions. So the first thing I'm going to do is to explain what a journal is. A journal is a report that includes all of the financial transactions of a business for a specific period of time. It shows the complete effect of each transaction using double entry accounting, and all the rules of double entry accounting must apply. And it's entered in chronological order with reference numbers and a brief explanation. To introduce journal entries, I'm going to go back to the SoftWhite SA example, and let's take a look at the 10 transactions that we analyzed in the introduction. The first transaction involved an investment by Ray and Barbara into the app development company, and we agreed that it would result in an increase in cash, and it would also increase equity. And so now let's take a look at this transaction in the context of a journal entry for accounting purposes. What you see here is the general format for what is known as the general journal. And I'd like to explain what this is, and then also how we can make a journal entry for transaction number 1. So you can see the headings, the date, the specific date in which the transaction occurred, the account titles, and also a brief explanation, a reference number, and then the associated debit and credit. So let's take a look at how we can journalize the first transaction for the initial investment. And this would be it. You can see here the date is September the 1st, and remember that we had an increase in cash. We show an increase in cash as a debit entry. We also had an increase in share capital, and that we show increases in equity accounts as a credit entry. Also, the way I use reference numbers is by the journal entry number. So this is the first journal entry. I'm going to call it reference number 1. And you can see here the debit entry for cash is in the debit column. The credit entry for share capital is in the credit column. And just as a quick review, just remember there are these 5 things that you need to pay attention to when making journal entries into the general journal. The date, the associated debit, the associated credit, a brief explanation, and in this case, issued shares for cash. That's nice and simple. It doesn't need to be a long explanation, but something short that you, the reader, will understand. And finally, a reference number, so that if you need to, you can go back and you can reference a specific journal entry just to check, because it's really important to be able to cross-reference your entries. Let's take a look at one more and only one more transaction, and then we'll continue on. So the second transaction was the purchase of equipment for cash. And in this case here, we agreed earlier that we're going to use cash in order to complete this transaction. So the cash account is going to go down, but we're acquiring equipment. And so our equipment balance is going to go up. Now let's take a look at the impact on the journal entry for this transaction. This is the first transaction, and that's all included in the general journal. The second transaction that would follow then follows. On September the 2nd, we purchased equipment. We show increases in assets with a debit entry, and we show decreases in assets with a credit entry. So we use cash in this case. And the reference number, this is the second journal entry, so I'm giving it a reference number of 2. And in my explanation, I purchased equipment for cash. These explanations are very important because it's not only you that is reading the general journal. There may be others. It could be your supervisor. It could be the CEO of the company. And so you need to make sure that other readers will be able to understand your journal entries. So now we've learned how to analyze financial transactions from an accounting perspective. We've also learned how to make accounting journal entries into the general journal. And next, we're going to look at how we apply that to ledgers. We'll see you soon.